Let's get started. I want to start with some of the basics. Everyone here in our audience knows in any M&A deal, you need to have a basic understanding of what drives and influences business valuation. So Vanita, maybe we'll start with you on that one since you are the valuation expert in this space. Having personally worked on many M&A deals myself, I kind of feel like cannabis valuation is all over the place. There doesn't seem to be any rhyme or reason behind it. Can you tell us a little bit about why that is and what valuation techniques are being used to determine the purchase price of a cannabis company? Like our traditional valuation metrics being utilized, like multiples of sales, EBITDA, for instance, and do you see these methods evolving over time?
The methods the methods are much more complicated than anybody realizes. People want to talk about a multiple of revenue because it's simple. 3 times revenue is simple, but it really has very little meaning in the cannabis industry. Or a multiple of EBITDA, or a multiple of, well, anything pre-tax, because once you take tax out, pretty much there's not a lot left if the companies are actually paying their tax. But the valuation method that works well, as it does for any kind of company, is a discounted cash flow model. So when we do valuations for cannabis and any company, we do a really detailed financial forecast. We use the company's financial forecast if they have one. We help them build one if they don't. And we look out over 5 years. So the goal is to get past the point where we all estimate that the federal government will wake up and realize that this is not like heroin, that cannabis is not like heroin, it shouldn't be a Schedule I drug. So that will happen. And once that happens, these businesses that have a hard time making a net profit, an after-tax net profit, will go to being profitable. And so I think the higher values are going to businesses that have developed scale. They've developed scale, which is why the big publicly traded companies are valuable. They have scale. They're across multiple states. But so to get back to the valuation method, a multiple of revenue or any kind of multiple is going to lead you in the wrong direction if that's your only method. You have to do the work of a discounted cash flow methodology where you go out at least 5 years and present value, and that gives you a really solid value of the business.
Vanita, just to kind of, as a follow-up, you mentioned like EBITDA and the tax concerns. Can you kind of explain for the group why I, in my belief, EBITDA may be a little bit misleading or inappropriate way of using it as a metric, given the taxes in this industry?
Well, if when you're calculating EBITDA, you really do, it really is before all taxes. That's at least a level that you can use when we use it to compare companies to each other, because then all taxes are taken out in the way we look at it. But you really do, once, in order to value the company, you really have to account for the facts that these businesses will pay tax.
And a lot of tax.
And a lot of tax. So the only way to do that is not look at a multiple of EBITDA as your valuation method, but look at a discounted cash flow, and cash flow is after tax. So if you're looking 5 years out, if you make an assumption, is 280E tax going to continue for another year, 2 years, 3 years, 4 years? You have to go beyond that. You have to go beyond that point where 280E goes away and stops being the way cannabis businesses are taxed, and then cannabis businesses are taxed like every other business. And that will happen. We just don't know when it will happen. I think a lot of us thought it was going to happen this year because of the change in the federal government, and it hasn't happened. So I'm disappointed with that, truly.
Well, we're all waiting with bated breath. So, Vanita, would you say that there's like anything that you see is often overlooked by cannabis businesses in terms of their financials, like from the buyer side or perspective? Are there any red flags buyers should be specifically looking out for in a target company's financials?
Well, I think if you're going to buy a cannabis business, you can't just look at the financials. Because the financials are a product of the people who are running the business, and they do the best they can to account for everything. They hire accountants to do the best they can to account for everything. But if you're not doing a walkthrough, if you're not going and seeing the plants, I mean, the forecast for the business may be very, very rosy. And then you go and you walk through the grow and half the plants are dead. And you walk through the processing room and you see other kinds of problems. You have to go past, especially in cannabis. I think you have to go past the written financial statements that you've been provided with and go and see the business. And that's been really tough during COVID. It's been really tough. And I'm sure a lot of companies are facing those same difficulties. You need to go see the business, and it's really hard to do that.
Right.
But that's what's needed.
That's so true. Thanks so much, Vanita. Maggie, we just heard from Vanita about, what a buyer should, look out for. Can you, from your experience, talk to us generally about what red flags a seller should look out for with just deal terms in general?
Yes, I've gotten all kinds of kooky term sheets, including one to buy the company that had zero equity, and the cash was my salary. And it really makes you think, like, do you think I'm not reading this? Do you think I don't know how to read this? It's alarming. I've gotten some that was for 70% of the company, which is sort of a strange situation for my investors. I've had propositions that I personally get paid based on sort of the first year of Besito within the company, which is a perverse incentive for me to only run this brand versus almost all these deals I'd be running a portfolio. So egregious terms or lack thereof. And then, of course, I think especially in cannabis, there's just the people side and really getting to know them. And I had, it's not even strange behavior in cannabis, but I had behavior that had me walk away from deals, which is sort of excitement, and then not hearing from folks for 2 weeks or saying they'll do something and they don't. And just those gut feelings that, especially in most of these cases, I was going to go with the company. My future time is not worth sort of the behavior and some of the, bad behavior, bad actors that are not, certainly not everyone, but they exist in the industry and all.
Oh yeah, this is a very people focused and oriented space, I've come to learn. But Maggie, I know you have a really strong background in brand development and management. Now that the industry is maturing, we're seeing more and more companies do strategic acquisitions of what we call non-plant touching companies. They're called non-plant touching companies because they're not necessarily operators in the space. Maybe they offer some ancillary product or service, but some of these non-plant touching companies that are being acquired because they have, strong IP portfolios. And we're seeing a lot of these acquisitions because, these companies are hoping or expecting that having these IP assets will, increase valuation or for purposes of competition or both. I'm curious what you think about the current deal landscape for cannabis brands and other non-plant touching companies is like right now. Do you think, a company with, let's say, a strong IP portfolio, who's not necessarily touching the plant is more attractive to buyers or investors in this space as opposed to plant touching companies? And do you just have any wisdom in general you can share for a non-plant touching company that may be looking to sell or exit?
Yeah, so I think we're seeing fewer deals on the IP side, or at least that I expect to see more in the not so distant future. So the quick background here, me in California 5 years ago, I decided I did not want to build out sorry, I have a demanding puppy. Butter? Yeah, stay. I decided I did not want to build out the manufacturing facility. I had worked in CPG, co-packing was totally a normal thing to do. And I wanted to stay focused on what me and my small team were best at, which is consumer insights, brand and product development, sales and marketing, and just manufacture someone else's house. A few years in, I 180'd on that proposition due to a million reasons. A lot has to do with pricing pressure and sort of lack of brand loyalty and brand, frankly, not as important yet as I expected it to be. And so so that was the motivation behind me. I could have certainly kept going solo, but it solved so many of brought the entire supply chain in-house. Sourcing was horrible. And then ultimately, this is a price-driven market. I was paying up everyone else's margin along my supply chain and at the cost of my margin. So now with it in-house, actually able to lower wholesale and compete more. So that was my motivation. I think, and I did think it was, standing as a brand alone, I didn't find it extremely sustainable. I think there are a handful of brands who it could be sustainable that are unlicensed, but really like a handful, maybe less than 5. I think the more scale they have, especially if they're interstate or across several states, obviously that's a huge benefit. A lot of this, I think, brand IP is driven by the state-by-state nature of our supply chains. And so a brand that has been able not only, I'm thinking about California, of course, to succeed here, but to go to other states and has begun to collect national brand equity, brand awareness, that's huge. And honestly, there's so many brands today, there's a proliferation all the time. The past few years, of course, are the first few years of fully legal, but tons of brands coming and going, inconsistent supply chains. And all of this, I think, leads to this lack of brand loyalty. And so I felt like that IP was going to be helpful in the long term, but to get to the long term as a startup, I wanted to be part of a licensed group and a bigger ship. So the deal makes sense in that it's, to anyone else who has a portfolio of brands or even one brand, it's immediately accretive. And I think this asset light strategy only can work for a few who are able to get the scale. And I believe it's better to join up sooner than later at this point, is my hypothesis. And then the last thing I'd say as far as advice is, I think great brands sort of by definition are buzzworthy and meaningful, and people have heard about them and they capture attention. So I think that always had us look a little bigger than we were and helped me sell the company. And so that's something I encourage, is just being out there as known as possible and trying to break through all the noise, frankly, of hundreds and hundreds of brands.
Right. Maggie, we actually got a question from the audience, a very good one, I think, and was just wondering, due to the federal illegality of cannabis, there is very limited, if at all, protection for IP on the federal level. At most, you could really get trademarks, for instance, on a state-by-state basis. What do you think that, means for brands? How can a brand really be, worth anything given this limited protection from competitors?
It's a real problem, certainly. At the same time, that's due to the federal illegality, the nascent industry. The biggest, most legal brands in the world across apparel, jewelry, bags, whatever, also struggle with the same thing. So I don't think it's more of a hindrance than the other 1,000 things that are a hindrance to
Maggie, are you seeing with these folks, what are they doing? Are they just getting trademarks in every single state that they operate in, or?
Yeah, what the creative solution I'm sure folks have heard is trademarking for something more legal, like apparel and hoodies and website, which certainly you have at the federal level. And then, yes, luckily in California, we've been able to trademark at the state level. And then the other thing is the patent I have on this hexagonal vape. There's been a huge issues with copying hardware, and it's sort of alarming. It's like, it took me 2 years to build this, and someone managed to get it out in 9 months. I'm impressed. So yeah, it's beyond brand, and it can be product and hardware too. And yes, it's a risk, but I think you keep going, you keep your head down, and you build your business, and your consumers and the industry know sort of who's really behind it and what the real deal is. And of course, it's so highly regulated, you're not going to find an accidental Besito in a dispensary.
Right. I mean, Stizzy, I know, is California. They're expanding to other states. What are you guys doing with your IP protection strategy? Just getting trademarks in every single state, or how are you guys handling that?
Yeah, I think that's right. I don't know, the lawyers handle that, so I really honestly don't know. But I think we have, my guess is we have federal trademarks filed. I don't know if they've been approved, certainly for certain uses. And like you said, I think in all the states that we are currently in, and all the states that we think we'll be in, I think we have, and internationally as well, we have patents filed statewide and internationally as well.
Right. Well, Tack, we just heard from Maggie earlier about what's, the seller side of the deal. Shryne, you just mentioned, has 17 stores, retail shops in California, on top of its production facilities throughout the state, and that you guys are looking to expand nationally. As the head of expansion over there, how do you look at potential acquisitions? Are there certain kinds of companies that you specifically target? What is the value driver you look for as the acquirer in this space?
So a lot of the licenses, so what we try to do, as I mentioned, is we try to grow organically when possible. Different states and different cities open up the process for people to apply. But when we can't get into a certain jurisdiction where we're very interested in, that's when we turn to the M&A. And as far as value driving, it really comes down to geography and location. When I mean geography, I'm talking about we look for certain states, certain counties, certain cities that have a limited number of competitors, a limited number of licenses, and where we think our brand, Stizzy, and I think you mentioned you've been to our stores, but our stores also have a certain feel to it, where the Stizzy store and the Stizzy brand would resonate with the people of that geography. And what I mean by location, though, is also, as you know, a lot of these licenses, whether it's cultivation or retail or distribution, are usually tied to some kind of real estate. It's certain cities and states will allow you to move them, but more often than not, they're tied to an address. And so the key, at least in our experience, is location is obvious, but is the key. Whether it's being next to a freeway, we try to be next to either a freeway or a major intersection, and have over 30 to 40 parking spots. And so those are the key drivers for us, is the geography and the location.
Okay, cool. You know, back to the theme of red flags. I'm sure there's been a number of, you know, failed acquisition deals that you thought was going to go well, but for some reason the deal blew up or didn't work for whatever reason. Are there any specific factors or that give you any indication if an acquisition is really going to close or not? Any red flags from a seller's perspective?
So yeah, I think
buyer's perspective. I'm sorry.
But yeah, I think because cannabis, even though it's expanding, it's a relatively limited space as far as the players out there. And so I think it was Maggie who mentioned about reputation and the type of people you come across. And so I think that's the key. Is I think there's certain people and certain companies that are kind of developing a reputation for either being litigious or not following through on their initial LOI or their word. And so it's unfortunately more common in this industry, honestly, than in all the all the other industries that I worked in as an M&A lawyer. And so I think what we try to do initially is to try to get to know the people that we're dealing with on the other side of the table. If we have any kind of if it just doesn't feel right, then we might conduct some diligence and see if they've been involved in any lawsuits. And that's been a really good tool for us, is these lien searches and these litigation searches to see the types of people we're dealing with. And more often than not, when we have kind of a feeling in our stomach about someone and we conduct a litigation search, it pops up with a lot of hits, and that's when that maybe we need to do further diligence or tighten the deal terms or tighten the purchase agreement or whatnot. But I think reputation and kind of a litigation history are major red flags for me.
Oh yeah, but same red flags for me. I know you mentioned in your prior life you were a corporate attorney in big law. You also previously headed up acquisitions for MedBen. I'm sure you've got some interesting war stories to share one day, which we should talk about one of these days. But can you kind of just share with us, to the extent you can, some of your personal experience dealing in the M&A space? Like, how has the cannabis M&A landscape changed from the first deals that you initially worked on compared to the deals you're working on today? Do you think it's more of a seller's market or a buyer's market right now?
I think as far as the private companies and the private assets, I definitely think things have come 180. When I was at MedMen, we were looking at raw licenses, purchasing them for $10 to $15 million. If it was an operating license, then it would be maybe 1.5 to 2x revenue. But I think as people have started to realize how really difficult it is to be cash flow positive, have actual net income instead of just EBITDA, I think those multiples have gotten much smaller. We're mostly interested in buying raw licenses at this moment, just because from our experience, buying a operating license can come with a lot of hair. For example, if a certain dispensary has a history of catering to veterans or medicinal patients, a company like MedMen or Stizzy, that might be a different clientele than a different type of company that the existing clientele is looking for. As far as, and so these days, I think raw licenses, from what I've seen, are going from anywhere from $1 million to $3 or $4 million. And so I think from as far as the multiples and valuations, we've come a long way, and it's about 1/5, 1/4 of the valuations that I saw when I initially started about 2.5 years ago.
Vanita,
Yeah.
what about you? Are you seeing those kind of same valuation trends as talk?
Well, yeah, I think it's harder to find. I think it's harder to find really good licenses and really good deals. And so we don't frequently value licenses individually. We're usually valuing the business as a whole. Although for instance, for an acquisition, a purchase price allocation, we might value all of the licenses as an intellectual property asset. And so, yes, the values have gone down. I think they're more realistic. I think people realize that the closer we get to legalization, the more that maybe the less the licenses will be worth, because there'll be more available, more competition.
That makes sense. Jaime, I know we've been talking a lot about M&A, but I did a Google search on Henry's, and it looks like you guys closed a couple rounds of cap raising. Was just wondering, in your experience, can you just generally tell us what kind of capital markets are available in this space right now? Are you seeing the same types of investors that were interested in cannabis maybe 3-4 years ago? Or are they the same types of investors you're seeing now today, or is it changing?
The same types of investors are still around. We've traditionally raised from high net worth individuals or cannabis focused venture capital firms. And, many, but not all venture capital firms are kind of poisoned wells at this moment, right? They have a series of assets that in their portfolio that haven't performed well. They've had a school of hard knocks, so to speak, right? So, to everybody's point, the valuations have definitely tightened. I think we have enough historical context on publicly traded companies to, at least for the private space, to kind of value your company based on, what a, tier 1, tier 2, tier 3, and 4 public company is trading on. For us, I've kind of transitioned from, there's certainly still cannabis focused venture capital firms that are interested in investing. But, I think at this point, as more people and firms have come into the space, what I'm starting to see is more family offices interested. The family offices aren't just investing in venture capital funds and kind of co-investing, but they're actually making their own placements into companies. So I would say that's a newer space and been the most interesting from my perspective. Yeah.
Wow. So was all, well, you don't have to go into it, but in general, are you seeing, or you think it's from a business perspective, from the company's perspective, are you seeing more debt or equity financing in those raises? And, do you see one being one better than the other very specifically for this space?
I mean, debt is fantastic if you're spitting off a lot of net income that you can, pay your debt down. I think debt is a pretty dangerous game. And the answer is, of course, I see senior secured debt everywhere. Who doesn't want to be a debt lender? Right. At the same time, for my company, I've taken on, the only debt I've taken on is, leasing or financing equipment for our production facilities, pre-roll machines, batchers, sorters, things like that. But as far as taking on any kind of operational debt that I don't think I can service, that more you've got a lot of funds out there that are getting, like I said, I think they're poisoned wells because they've taken a lot of knocks and taking equity positioned. And so senior secured debt sounds great. And I think that's great if you have an operator and, an operating team that can take over those companies when the organization can't service their debt. that being said, this is an operator's game. At the end of the day, the cannabis industry is an operator's game. If you're not a great operator, at least if I think there's a very select amount of tier 1 pubcos that have, a pretty substantial balance sheet that they're able to have a pretty robust C-suite. They're able to operate at a loss and tell the story of future revenues and federal legalization. But for most cannabis companies, I'd say in the 10 to $30 million in annual revenue range, it is an operator's game. You have to know what your cost of goods are, where you're putting your taxes below the line. You need to know your conversion rates as you're making finished goods. You need to be intimately involved in your business. So, yeah, that's kind of where we sit. And
Yeah, I've noticed this, especially with clients in this space in general, now that there seems to be kind of more, I guess, traditional capital sources available with these, like, cannabis focused PE funds, for example. A lot of the operators are kind of seeing this debt as like a potential, like, shiny new toy that they can access to, help not dilute their cap table. Obviously the debt, the interest rates are not competitive in this industry.
Yeah.
But can you kind of share with the audience, like, I know you're not a lender, or maybe you are, but for lenders in this space, are there, what are the struggles with collateralization for loans specifically in the cannabis industry?
Sure. I think it depends what kind of lender you are and where you need to get comfortable. If you're looking for asset-backed lending, not every company has been focused on their real estate assets. I'll take our company, and I know a lot of companies operate this. We stay pretty asset light. I would rather take leases and focus on being an operational company. So getting an asset-backed loan is, you're going to have to be comfortable with the leases, what is on the licenses, what is on the facilities, the inventory, and that goes back to, you're going to need to have an operations team to step into the business should the business not be able to service the debt, right? So I just go back, this is an operator's game. Whether you have to think about that. If you're going to come in, take a debt position, everybody should know we could all probably count on one hand the companies that will actually service that debt. What happens is you're going to raise an equity round to service that debt, period. You're buying time when you're taking debt. That's what you're doing. So, I think there's interesting debt plays. There's always, you can create an SPV and have some, like some kind of internal sale leaseback, or you can just go out to a REIT and do sale leasebacks. I think there's all sorts of, you can raise debt for property, but there's not a lot, like I said, for me, what I see the best debt available at, and you're seeing it anywhere, I'd say from 10 to 20% interest, is for equipment financing. You see debt out there for, factoring or receivables, but it's pretty rapacious fees, right? You're talking anywhere from 36 to 100% APR, right? It's typically monthly APR, 2 to 5, 6, 7% per month. So it depends what the lender, what they can get themselves comfortable with. There is a place for factoring and short-term debt between, we'll say, retailers and brand, or distributors and brand, if you're selling bulk materials, whether it be oil or flour. But as far as long-term asset-backed debt, we see it out there, but it's not too attractive.
Yeah. This is just a question for anyone or everyone here, but we've seen a lot of really big deals taking place in the past few months. This past May, for instance, we saw like a $4 billion merger between Aphria and Tilray, or two cannabis giants up in Canada. We also saw an increase in SPACs, such as the formation of the parent company, which was fronted by rapper / entrepreneur Jay-Z. What do you guys think is driving this big deal trend this year? Did COVID-19 have anything to do with it? Do you think we should expect to see more action like this for the remainder of the year?
I think the SPAC, if I may, just on the SPACs, you're seeing big deals with SPACs because it's great for the sponsors, right? Who wouldn't want to do a SPAC? If you're the sponsor, you get the upside and the downside security. So of course you're seeing those come into market. But it's always interesting, right? When you see them de-SPAC, what, goes well below the warrant price. And, what I think the parent company's at $4 or so. It's tough. SPAC's tough. We'll see how they pan out long-term. I'm actually surprised we haven't seen more big deals, right? Or even more middle market deals. Like, we've named two, but I think we're really just seeing distressed assets for the most part.
Mhm.
I think,
Yeah, I
I'll
think-
chime in. I tend to agree with Jaime on, you mentioned two deals, but I think right now with, in March, after some people thought that there was going to be federal legalization because Georgia flipped from Republican to Democrat, I think the stock market and the valuations were incredibly strong. And that's kind of come down to earth. And I think we're at this point where we really don't know when federal legalization is going to happen. Is it going to be 4 years? Is it going to be 2 years? And so I think that's part of the reason why we're not seeing as much M&A action, is because people are kind of sitting on the sideline trying to figure out which way the market's going to go, depending on what the Senate and what President Biden does, and what's going to come out of the SAFE Act and the MORE Act and those things. And so I'm actually kind of surprised at kind of the lack of activity as far as M&A. I think as far as IPOs and SPACs, I think people had started that process 6 months ago when the markets were on fire. And I think we're going to continue to see that, just because it's a necessity for people to raise capital. But as far as the M&A activity, I think it's going to be kind of quiet maybe for the next couple of months.
I was not surprised at the Afria Tilray combination. I was not surprised. I think you've got two giants, and instead of butting heads, they've decided to work together. And I think I think that may continue. That kind of merger activity may continue. And what you're doing is building Coca-Cola, right? You're picking the best companies, the ones that seem like they are maybe the most successful, the ones that have staying power, the ones that have cash on the balance sheet. And I haven't looked at their balance sheet, but you're looking to build the giant. You're looking to build Coca-Cola. And so I think it's totally reasonable and rational that those two companies would join forces.
Okay, well, now I'm going to ask all you guys to look into your crystal balls. Now that more and more states are coming online, the movement's going east. And I think, to be determined, we're getting closer to federal legalization. How do you guys see federal legalization affecting deal trends and valuations in the future? And who do you think the winners are going to be on a go-forward basis? Is it the MSOs? Is it the non-plant touching companies? Would just love to hear your general thoughts and predictions for the future.
I don't want to go first.
I'll go first. Whatever it is, in my experience, it's going to be longer and a lot more difficult than we expect.
Mm-hmm.
I think even if if a federal bill passed in 2 years, I'm guessing at least 2 years before, real commerce across state is happening. It's been my experience, at least, that everything is slower than we think. And so I'm very curious to see how everything plays out until then. It does really feel like a lot of folks are still, and I've seen this at the industry, going their own and like really wanting to stay independent. And yeah, it's a great mysterious question.
Yeah, I guess I'll chime in. I think I completely agree with Maggie, and as I just mentioned before, I think we're looking maybe 2, maybe 3, maybe 4 years before federal legalization. But what I think that the key thing there, and I think this kind of goes to what Vanita was saying, is once that happens, we're already starting to see this with the tobacco companies, but you're going to see more blue chip companies, Amazon or whatever, these types of companies that have distribution networks in place already. They'll probably get into the put their hat into the cannabis industry, which presumably would be good for the existing operators and license holders. And so, unless the market's already kind of taking that into account, I'm not sure. I do think that federal legalization, as far as I guess from two perspectives, obviously getting rid of 280E, but also I think even more importantly, getting big banks and big blue chip companies into the cannabis industry. That's really going to increase M&A activity, and whether that's good for the industry is a completely separate topic.
Mm-hmm.
I agree.
Just because cannabis becomes federally legal, that does away with 280E, or at least the reason for 280E taxation. That makes a lot of cannabis companies that have been sort of on the edge. They're operating well, they're lean, they are doing everything right. They're really close to being profitable, but they're not. They suddenly become profitable. And so I see that federal legalization is a huge deal because 280E goes away. I mean, the only reason for 280E is if you're selling an illegal drug, a Schedule I illegal drug, and cannabis is still considered a Schedule I drug. So as soon as it's legalized and descheduled, then the reason for 280E goes away, and all of your taxation changes. The companies that were close to being profitable. I'm repeating myself, but it's so important to see that the companies that were close to profitable are going to be profitable. It's going to be a sea change.
I love the optimism. I question whether, I truly do. I question whether that is going to be negated by a federal tax that will be more substantial than any of us realize. But we'll see. I hope that is the case, and I hope they're sensible about the federal taxation. I agree with everybody here. It's going to be long. It's going to be painful. It's going to be longer than we think. I think we're going to see, at least what we've experienced in California here with the oscillation really of supply shortages and supply gluts. We're definitely in a glut right now at this moment in time. We'll see who goes out of business, and we'll see what happens to supply next year. So I think that whole experience in supply is going to be amplified with federal legalization, and as we see this roll out on the national scale. So it'll strap in. It'll be fun.
Well, the only things certain in life are death and taxes. Vanita, I know you're talking about everyone's talking about 280E. For those of you in the audience who are not familiar with 280E, 280E is a section in the tax code that prohibits companies that are engaged in unlawful federal activity from deducting ordinary business expenses, just like any other normal business would, besides costs of goods sold. And I don't know if this is folklore or not, but I heard that the reason 280E was enacted was because some mafia hitman was able to successfully deduct the costs of his, hits, like his mileage or his meals or his weapons used in the job. And after that hitman was able to successfully exploit that, boop, they created 280E. Little did we know 280E would just impact mostly all the cannabis businesses in the country. Right. Even if they're state compliant. And Vanita, can you just kind of educate everyone, like, what does that mean? And what is this with 280E? What does this often turn into an effective tax rate for operators in this space?
Well, it means for many operators, well, if you think about paying, you all pay your federal tax after deducting all your operating expenses. if you're a store, like a dispensary, but if you're a store, you get to deduct the cost of the rent on the store and the people who work in the store and the lighting for the store, all the operating expenses of the store. For 280E, the federal government considers that the cost of trafficking. And Michelle, I've heard the same story, that this was based on a mobster who wanted to deduct his cost of the hitman and, the cost of, what the federal government called trafficking. Now, I've heard that it's Al Capone that they were talking about, but I think Al Capone came much earlier. So I'm not sure that that's any more than lore. But yes, I've heard that it was based on a mobster trying to deduct his trafficking expenses, like the cost of the cars to deliver the drugs to the people.
Wild. But yeah, I mean, with that, it looks like we're coming up close to being out of time here, unless anyone else here in the audience. Let me just double check, see if there are any questions out there. No, I mean, with that, I would just really recommend everyone in the audience, if you have any questions at all, please feel free to reach out to our panelists. I strongly recommend that you sign up for Vanita's quarterly newsletters. They are fantastic. If you want to get a flavor for how multiples are all over the place, that's where you can get that data for public companies, private companies, plant touching companies, non-plant touching companies. It's a really good comprehensive compilation of data that I don't think anyone else publishes out there.
I haven't seen anything like it. And thank you for that. I love that pitch. And I do send them out to everybody. Of note was I was in a cannabis court case, shareholder dispute, a couple of years ago. And the expert for the other side brought my cannabis studies to his deposition and we asked him why. Why would you bring my studies? And he said, because there's nothing else like that available, which made me feel really good. And one more thing, Mayor Rosenberg, who's another dear friend, gave us an update in the chat on the origination of 280E.
Oh.
And it doesn't sound like it was from Al Capone.
Al Capone can no longer deduct his duct tape expenses. Let's just put it that way.
That's great. That's great. Well, like I want to. That's a funny and yet relevant way to end this panel, I guess. So for those of you out there, I know there's been a few people who I think are viewing on iPhone or maybe iPad, and we're not able to download the report that we referenced. So just know that Sheena Nickerson from ACGLA will send out that report via email and some additional information. Look for that either later today or perhaps early tomorrow morning. I want to thank everybody, Maggie, Tak, Vanita, Jaime, and of course, Michelle, who was the driving force at Greenberg Glusker for bringing this group together, constructing the conversation today and moderating it. Thank you, Michelle. Thank you, Jaime. Thank you, Vanita. Thank you, Tak. Thank you, Maggie, for sharing. This was a bit of a high-level look at what is a fairly complex and ever-changing environment. On behalf of ACGLA, what we would like to do is probably launching in 2022, have a bit more of a structured series around this. God willing, in person, but who knows? Those goalposts are ever shifting, it feels like. But we would like to dig deeper into this. California, certainly, LA and the Bay Area have an outsized impact on the direction of this industry at all stages, as I think of it, from almost like field to fork, if you will. And so I think that representation is important on the business level, on the social level. And so we want to be a part of that conversation on behalf of ACG Los Angeles, as well as ACG San Francisco. I do want to recognize Tyler Smith and our friends at ACG San Francisco who partnered with us to promote and put this together. And we look forward to, I think, online continuing to work with Tyler and ACG San Francisco, and then in person if we can do that as well. So going forward, as mentioned when we began, Shryne Nickerson is going to step in as our MC, as our small group networking DJ, if you will. We're going to invite those of you in the audience to stay if you'd like to participate in small group